The post-results management conference calls with investors and analysts have truly democratized information. To know what the management is like and what it is thinking, you no longer have to wait months for an appointment. Nor do you walk into their plush offices to get few minutes of their attention. All you need to do is dial into the call and listen. For instance, the recent conference call with the management of Paytm or 197 Communications was enlightening and confusing at the same time. I dialed into the call hoping to understand how the payments entity hopes to get its house in order. Instead, Mr. Vijay Shekhar Sharma kept listeners hooked on to his plans to offer Gen AI features like personalized spend analysis songs. Going further, he elaborated on how he wasn't excited about just another cost-cutting tool. Rather, for small shops, Paytm wants to offer AI agents via its soundbox and other custom devices. Ones that could act as the virtual COO, CFO, or CMO for store owners paying subscription fees plus inference fees for AI usage. By the end of the call, I was not sure if the business was about payments anymore. I would say something similar about listed edutech businesses in India, where traditionally the core idea of education has taken a back seat after a point of time. Why do I say so? Well, listed edutech companies in India particularly have a checkered history, especially ones that grew too fast and too much. Ones that expanded into new geographies at a blistering pace, and ones that raised investor funds either privately or through IPOs. Byju's did grab a lot of headlines since 2020. The company's constant spate of acquisitions made it a regular feature in media reports. The entity's coding subsidiary, White Hat Junior, became very popular during the pandemic lockdown. Byju's also poured hundreds of millions into marketing, signing Shah Rukh Khan and Lionel Messi as brand ambassadors. It became the main sponsor of the Indian cricket team and official sponsor of the 2022 FIFA World Cup. But as losses widened, investors exited the company near bankruptcy. The scale of shareholder value destruction also attracted attention. But Byju's was not listed, so its value destruction did not affect common retail investors. Edutech companies have tried their luck in the stock markets for a few decades now. Unfortunately, each time the companies got the shareholder value creation math wrong. And along with the founders of the Edutech ventures, the minority shareholders too learned many lessons. Or so it seemed at least, until the Physicswallah IPO came along. Entities like Educom, MT Educare and Treehouse Education have tried and burnt their fingers trying to grow in the hyper-competitive edutech market. MT Educare spent huge amounts post-listing as the company invested in technology to launch the coaching classes on an app and a tab. It roped in celebrities like Amitabh Bachchan as a brand ambassador. Back in 2015, it was the only edutech company moving from an offline model to an online model. The entity did not understand the unit cost economics of running online edutech venture. 6 years prior to MT Educare's listing, Educom, founded by an IIT Delhi and IIM Ahmedabad alumnus, got listed. The company debuted on the bourses in 2006, riding the school digitization wave with their Smart Class product. Educom's market cap touched Rs 100 billion in 2011, but the high upfront investment in deploying tech solutions across schools created liquidity issues. Educom lost investors and lost money when its market cap nosedived to Rs 2 billion and finally went into insolvency in 2017. Similarly, Treehouse Education rapidly expanded its preschool network fueled by investor confidence and an initial public offering in 2011. The company's financials rapidly deteriorated around 2016 with a sharp drop in cash reserves and decelerating revenue growth. Allegations of financial irregularities, including related party transactions and issues with receivables, severely damaged investor trust. A proposed merger with competitor Z Learning was called off further crippling its standing and triggering a wave of branch closures. Ultimately, the financial distress and loss of credibility led to the collapse of the widespread preschool chain. Let's talk about Physicswallah now. Physicswallah certainly has stronger fundamentals to boast of compared to peers. The entity's FY25 revenue was 10 times that of competitor Vedantu. In fact, Physicswallah's revenue was comparable to offline coaching ventures, Allen Institute, and higher than Akash Education's. Physicswallah banks on its popularity through its open access approach. It offers several courses and content for free on YouTube and social media apps, which helps it create a brand value among students. This, along with platform-specific offerings such as ability to download notes, structured curriculum, access to study tools, and ability to avail offline classes, is intended to encourage students to organically become free or paid users. So, Physicswallah's online community of content users acts as an organic fuel for students to consider its offline and hybrid channels. The company closely monitors the geographical density of the students using the free and paid online courses and other marketplace platforms to plan expansions and strategic acquisitions. For example, it expanded its offline centers in the states of Rajasthan and Uttar Pradesh by acquiring Utkarsh classes. Like its predecessors, Physicswallah has also dabbled in new tech back offerings to cross-sell and upsell its products. While so far the company seems to be keen to improve balance sheet and return ratios while keeping growth intact, investors must not forget history. It may be too early to give Physicswallah the benefit of doubt that the stock will prove to be very different from that of its earlier listed online edtech peers. Hope you like this video. Thanks for watching.